Last April, May, when the ECB reduced their interest rates, it wasn't passed on to customers with variable interest rate mortgages. And essentially, what happened then was that there was an increase, a 0.4% increase for AIB customers on variable rate mortgages, and a 0.25% increase for those in EBS. Now, I raised in it all the time that there seemed to be a syndication between, what the ECB does and what AIB does with its variable interest rate mortgages. Now, the point has been already made that outside of the loan book that are distressed, there are quite a number of mortgage holders who don't come across the distressed or don't come within their distressed category, who are feeding their mortgages possibly before they're either feeding their children. They are struggling to pay their mortgages. They are doing it. They're succeeding in doing that. But an interest rate increase could really tip them over the edge, and then you're going to have to deal with that situation. Now, every time this happens, there's always a conversation about, passing on interest rate cuts to variable rate customers, and it doesn't happen. And then, the last time there was actually an increase. It has been suggested to me that the accumulated wisdom amongst yourselves is that a 5.5% interest rate for variable rate mortgage holders is the most sustainable for you to continue in the future. That's not sustainable at its current level. Now, I would like to get your response to that. If you think is what has been suggested to me wrong, do you think you can continue at your current level? What do you foresee to happen in the future with variable interest rate mortgages? And how would you react to the charge that basically you are forcing variable interest rate mortgage holders to pay for tracker mortgage holders to stay as they are?
I think I'll ask Bernard, who's been working with a lot of this, to come make some comments. But variable rate mortgages and tracker rate mortgages have absolutely nothing to do with each other and do not fund each other, and we'll explain that. Secondly, they do not have any association with the ECB rate. That's not an issue of correlation at all. So really what it comes down to is the cost of funding of the bank. What does it cost you to fund, to lend? And what are the marginal rates of recovery on that? And that's what drives a lot of it. So just to get to the specifics, I'd ask Bernard to make some commentary on it around the rates, and I'll come back to the final comment around the rates you mentioned.
So the main points are exactly those, which is the cost of funding the mortgage book is based on the funding cost for the bank. For a very long time now, ECB has not been a funding cost for the bank. And the predominant funding cost for the bank has been the deposit cost to the bank, and then on the other hand, what it's doing in the wholesale marketplace in terms of ancillary funding for that. ECB has been a decreasing portion of our funding, and the ECB funding was always associated quite clearly with the proportion of our distressed book that it was funding as we were trying to delever that program. So that was ECB gives you funding to fund your deleveraging assets. As you sell those assets, pay off ECB. That was that sort of logic. So ECB as a movement in the marketplace, which clearly has come down to a very, very low rate, is not the basis on which the bank can fund itself today, tomorrow, or in the next few weeks. It is the deposit base of the bank that is funding the bank. So that's our core funding cost. Incrementally on top of that, then we have the cost for wholesale funding transactions, which are more expensive than that. The second thing that we add on top of that is the operational cost associated with just running a mortgage book, and then on top of that we put in a margin. I think when we were here 10 months ago, we probably did talk about where rates are going, and we talked about that the rates at sort of levels below 5% may not be where it stops. We have no intention at this point in time, in terms of this year, in increasing rates. What I can't guarantee in terms of where funding costs go, that the rates you're talking about won't appear again. And if you look at the UK marketplace at various points in time, and if you look at European rates, long-term rates do move between somewhere around 4.5 to 5.5, 6%, with very low base rates. Obviously, if base rates go above and funding costs in general rise, then different things happen. So the rates we're at the moment are where we are trying to get to in terms of establishing a viable bank that can generate profitability out of the loan book, which is the standard variable rate book, with no cross-subsidisation ever factored in, considered or thought about for a tracker book.
Have you made a kind of a calculation within that, the damage that would do to your, the impaired loans, the distressed mortgages, an interest rate increase of that nature?
Yeah, this is
the full percentage.
This is a very difficult issue, because the point you're raising is a valid one, and it's one that, by the way, under a regulatory obligation, that every time we do increase rates, we must consider what is the impact of the rate increase on our book. So we formally got a regulatory obligation to do that. But the other thing we have to do is get to the point where we generate our own capital. If as a bank we don't generate our own capital by making profits, then every year we will need more capital from somebody to fund the bank. So we have this dual obligation of, we need a mortgage book that is profitable, that generates sufficient return to actually generate capital for the bank, and that is what we're trying to do, and that is where the standard variable rate pricing has been picked, is based on a bottom-up calculation of our funding cost, operating cost, and a margin to get us to the point where we can generate profitability out of the standard variable rate book as a standalone book, rather than as some cross-subsidisation between trackers. So there is no cross-subsidisation and no calculation of cross-subsidisation between a tracker book and standard variable rate.
But to be clear, if I'm drawing the inference, we're not planning to increase it by a percentage. We're not planning to increase it at all. And we are cognizant of the consequences in economics. We don't live in a vacuum. You're looking at long-term average rates, which would give a margin which would allow a bank to get profitability and create capital. You would see them as probably higher than they are today. But it is only if the cost of funding changes. And as we are today, we're comfortable with our cost of funding and where the mortgage is. So there is no 5.5% or perceived wisdom of a number. It is a variable factor based on your cost of funding. And if your cost of funding goes up, absolutely, your rates go up.
I look forward to maybe next year quoting that, and hopefully you have been proved right and I have been proved wrong. 3 minutes, great, but that's enough for Priory Hall. Can I just ask in terms of Priory Hall, and I just want to reiterate the fact that there are so many families who are clinging on to every word that you say. So I just want to give you an opportunity maybe to say what you want to say about Priory Hall in as careful language as you possibly can, because when they hear words like new homes or they hear about a final solution, they want to know what that means. We all know how difficult this situation is. I would also agree with other people that there's a number of other situations that are coming right around the tracks for you guys and for other banks as well, because of the madness and the sellotape type constructions that were put together the last 15 years. Anyway, can I ask you, you've said a number of weeks, you've said positive solutions, you've said new homes. Can I just ask you again, and considering the fact that your words would be pored over and read over and clinged to by people who are really in absolutely desperate situations, just to give you the 2 minutes to say what you want to say, I think that would be very much appreciated by everybody.
Well, let's just put it in context.
Before I give you a chance, I would make the point that the family say that your bank has been more positive in dealing with than any other. That's not saying a whole lot, but it's saying something.
I'll take whatever small amount I can get, Deputy. This is a very serious issue, but I don't want to overrate what we're doing. We are only 18 out of 189 homes. Well, we're 27, but 18 principal dwellings. So I'd be careful about people misinterpreting what I'm saying. I'm talking about where we have 18 homes that are AIB's mortgage holders, which are within the control of AIB. And
Does that include EBS?
yes, sorry, the AIB group, my apologies. And within the context of that, we have been very specific, which is we have already contacted those customers. So it's not that they'll be reading this in the news today. We have contacted those customers. We've been unsuccessful with 4 out of the 18, I think, in total. We've had to leave voicemails, etc., as we've contacted over the last period of time. And we have made the decision, as I referred to before, not on the grounds of legal cases, not on the grounds of anything else other than frustration, because we understand this is a particularly unique situation. I'm not 100% convinced it'll always be a read-through to a next pyrite issue or something. I think we have to look at each case on its own merits. But this has gone on for a long time. I don't think it's anybody's fault. With the best will in the world, it's been a circle. And we're in a position where at least the Dublin City Council are paying the current accommodation and we're moratorium on the other. But if anything's going to change, in our view, it has to be that we put a long-term solution in place, and along the principles we've discussed. So what we've done is contacted and said, we want to put a long-term permanent solution in place with you, and we will engage with you in the next couple of weeks with ideas on how it will work. Will you be happy to take our call? Will you sit down with us and go through that? And in all cases, bar one, I think, everyone's happy to do it. So there will be, and this is not, we're in a very public universe in saying it now. So we're deadly serious. We will try to make this really work. With each individual, you probably have different solutions. different circumstances. I can't view that today, but we will sit down with the objective, if that's the best way to describe this, Deputy, of getting them into a home and out of the current temporary circumstance.